Why the entire US market needs to drop from time to time. Why does it seem like every stock, every index, whether it's the Dow, the S&P 500, takes a hit as if struck by the same bullet? This is what we'll explore in this video. Today, almost every American has a stake in the stock market, directly or indirectly. According to the Federal Reserve, nearly 53% of US families own stocks as of 2020, either through individual holdings or retirement accounts like 401ks. These investments aren't just numbers on a screen, they represent the dreams and futures of millions of people. The S&P 500, for instance, is a cornerstone of many retirement portfolios, touted for its historical average annual return of around 10% since its inception in 1926. But what happens when those indices decline over a long period? Panic sets in. People cut back, fearful of losing their nest eggs, and this fear ripples through the economy. Imagine this, a country with 1.2 million citizens, and 1 million of them are investing in the S&P 500. The index climbs, people make profits, reinvest, and it becomes a self-fulfilling cycle. Wealth seems to appear out of thin air, and suddenly, work feels optional. But what really happens when everyone is all in? What happens when, inevitably, some need to sell? Historically, the market has seen this play out. The dot-com bubble in the late 1990s is a prime example. Stocks of internet companies skyrocketed, fueled by speculation and the belief that the internet would revolutionize everything, until it didn't. In 2000, the bubble burst, wiping out nearly $5 trillion in market value by 2002. This moment, this glass bubble, could shatter as quickly as it forms. The market could crash, wiping out fortunes, and with it, trust that is far more valuable than money. After all, money itself is just paper. It only holds value because we believe in it. So what's the solution? How do we prevent all the wealth from flowing into a single stream? How do we keep the cycle going, ensuring that new investors keep buying from the old ones, perpetuating the system indefinitely? Here's where it gets interesting. I can sense your thoughts. Why this constant need for new buyers? It sounds almost like a Ponzi scheme, doesn't it? Exactly. But they'll tell you there's a crucial difference between the stock market and a Ponzi scheme. They'll say, investments are backed by the real value of companies. Their revenues, profits, and assets support the stock price. But is that really true? While it's true that a company's financial health can influence its stock price, it's not the only factor. The reality is more complex. According to Nobel laureate Robert Shiller, stock prices often reflect investor sentiment rather than fundamentals, leading to bubbles and crashes. Mark Cuban once said, "The stock market is by definition a Ponzi scheme." And in many ways, it is the largest and longest-running Ponzi scheme in history. So, how do we keep this from collapsing? Simple, we need fresh blood. But what happens when the market is saturated, when everyone who could invest already has? That's when you create new indices, new avenues to soak up the excess money. The rise of ETFs, exchange-traded funds, is a modern example of this. With over 7,000 ETFs globally as of 2023, these funds offer new ways to invest in everything from emerging markets to specific sectors like technology or healthcare. And when there's no more room, you create a pause, a strategic downturn. Fear spreads, people sell, prices drop, and the market buys itself time. Because time is what this scheme, this market, needs to survive. Every day, new players enter the game. Some turn 18, others come from abroad. In the United States alone, around 4 million people turn 18 every year, according to the US Census Bureau. That's 4 million potential new investors annually who could enter the stock market. This influx of new participants helps maintain the demand for stocks, sustaining the market's upward momentum, even when older investors cash out or reduce their exposure. Globally, the situation is similar. The World Bank reports that the global population grows by approximately 1.1% annually, adding over 80 million people each year. In emerging markets, where financial systems are becoming more accessible, millions of new investors are being introduced to the stock market for the first time. For instance, the number of brokerage accounts in India surged from 23 million in 2019 to over 60 million by 2022, according to the Securities and Exchange Board of India. This dramatic rise in retail investors illustrates how fresh capital keeps flowing into the global markets. Moreover, renowned economist John Maynard Keynes once referred to the stock market as a beauty contest, where investors don't just buy based on fundamentals, but on what they think others will buy. This speculative behavior drives markets, but it also means that the constant need for new buyers is integral to preventing stagnation or collapse. Experts like Yale's Robert Shiller have pointed out that as long as this flow of new investors continues, the market can sustain itself, even if it's not always based on solid fundamentals. However, as Shiller warns, this creates a delicate balance. If the inflow of new investors slows, or if confidence wanes, the market's self-sustaining mechanism can quickly break down. And when that happens, the market needs to reset, whether through a correction or a more severe crash, to create room for the next cycle of growth. It's a necessary pause in what can otherwise become an unsustainable climb. So here we stand, at the precipice of understanding. The market is a game, a cycle, and the question is not if it will fall, but when, and how we as participants will respond when it does.